All right, we're heading into the last half hour here with stocks closer to the highs and the lows of the session. Let's go through the levels that matter. Mr. Kevin Green here with us in studio in Chicago for a little bit. All right, KG, so today we're kind of like treading water or what?
You know what? We're flagging a little bit. It's actually a boring day. We're range bound, and it's something that if we had this move to the upside over like the last 3 days, 4 days, like we've seen, seeing a little bit of consolidation is not a bad thing. What you don't want to see is a breakdown. And right now we're testing the upper end of this channel line if we're looking at the open interest chart, the 5-day, 15-minute chart here. Now what you would like to see going into the close is probably for us to stay within this range and then either breaking to the upside tomorrow or downside tomorrow. I think we have some economic data that can actually push us through here, but we haven't seen any type of breakdown. We saw some buyers stepping in around 56.03, and then we had sellers kind of selling at around 56.30, and that's pretty much where we're at right now. The resistance area of 56.30 continues to be on the radar. We'll continue to monitor that, and then 56.45 is actually the real sticky positioning where we could actually see aggressive selling to the downside if we do get close, just like we saw on Friday's session here. Once again, we're just in a consolidation. It's a really boring market.
This is, however, there's something to be mined here on a boring day, because for those that are like kind of still figuring out like what we're talking about here every day and stuff, this is a really good example of how it often looks.
Yes. Which
is you've kind of got your guardrails of where, you know, you kind of got your main kind of median of your highway that you're traveling down, which is basically this level we've kind of plateaued or flagged at. And then you've kind of got these big positions, you know, on the side kind of acting as expected barriers. Of course, eventually they bend and then they break, and that's kind of what we're monitoring. And right now, nothing really needs to bend or break when you're just kind of going like that.
Exactly. And if you're looking at some of the volume flows, it's pretty much balanced out for the most part. And if we actually look at the volume chart, you have you talked about a really good example of these barriers, and we can kind of break that down a little bit. When we're talking about the positive dealer pressure area, we're basically saying that there's a lot of call sellers that are sitting at that area, and those dealers are going to be long those calls. Now, they don't want to be able to obviously see a rapid movement to the upside here, so they're going to be able to sell into strength, which is kind of what we're seeing when we hit that green level. And then when we have that negative gamma level, that's just a lot of retail traders and institutional traders that are long puts. And so that's downside risk when it comes to dealers. Once we get close to that level, dealers try to go into that futures market, buy up those futures contracts in order for it to not try to go below that level. And sometimes it does go above, and sometimes it does go below. That's what makes a market there, and that's where we could have these extremes, either to the upside or downside.
Usually first time you get there, you kind of get that expected reaction, at least initially.
Yep.
Unless, of course, there's something huge going on.
Yeah, like Friday, we had this like massive candle to the downside. We were kind of meandering around, and then we saw about an 8 to 10 point flush to the downside, right, when we hit around 56.30. Same type of concept. You just saw an unwinding of positioning, and you like that fracturing of that positioning, and then the market actually calms down a little bit. Now today, for the close, the balance area is going to be 56.18. That just means that dealers are not seeing any negative excessive pressure or positive pressure as well. It's just staying even.
So we're likely to have a pretty chill 26 minutes here.
Yeah, for the most part. Yeah, I mean, you do have some volume, but it's not something that's really aggressive. It's not something that we've seen on Wednesday, Thursday, or Friday of last week here. 56.30 is going to be your first area of pressure where we could see a lot of resistance. Not surprising, over the last 2 trading sessions we've seen that. And then 56.40 is going to be your bigger area of focus. What you don't want to see, obviously, is going to be an unwinding of call positions in an aggressive manner to really flush us to the downside. Right now, we do not have that type of action taking place today.
Be kind of a sneaky move, though, to put in a higher high relative to Friday. It's only 6 points away. You know, like we are at this point hanging on to all of the gains that we've made along the way since the lows last week. It still is pretty impressive stuff, right? It seems like the onus is on the bears here to try and prove that they've got a role to play at this point.
Yeah, but I'll take the other side of that here real quick.
Yeah.
2 weeks ago, 3 weeks ago, we were doing the same type of action. 25-point ranges to the upside, fading 56.30, and we had that for 4 sessions.
Exactly.
6 sessions in a row, and then we actually broke to the downside. If we have that same type of action going into that Fed meeting on Wednesday, we probably will see either a break up or break down. I would be very surprised if we still see us trading around these levels by Friday.
That is so funny you say that, because that was literally my thought in that last week of August. I was like, all right, we've got to get away from this 56, and then we didn't, you know, and then we finally did over the, beginning of this month. We had the dip, we came back. But it's funny because I was thinking about this as like a, I don't know, trader or technical kind of like philosophy when you think about a range that was there for a long time. In the case of the range you're talking about from the end of August, when that breaks, do you see the odds that you could get stuck back in that range again, or is the idea that price has already been explored there and broke a certain way such that we're not going to get stuck? That my kind of thought is like we're unlikely to get stuck again. But we certainly did at one point.
Yeah, well, that's all technical analysis, right? You have support areas where support you find buyers stepping in, where we cannot flush through a certain price point to the downside. And then resistance is going to be the same exact thing. You have a resistance area where you just cannot push enough through. You have too many sellers there, not enough buyers in order to be able to break up.
Which is that 56.50.
Yep, and the market has muscle memory as well. So familiar levels, if we're talking about gamma levels, if we're talking about technical levels on a chart, they're all going to do the same thing. As soon as we get to 56.30, we're going to try to hang out here until you have a reason why you should break through a Wednesday price point, or break down.
Yeah.
Or break down. And this is what's really actually scary about this. I don't have this chart up here today, but the scary part is that if you're looking at the longer term time frame, the highs that we had, the all-time highs, the recent highs that we had back in August.
All so close.
All so close, but that trend line is still intact.
Still intact, yeah.
And so if you're going to fade those resistance areas, that's where this week could actually be either a really great thing, because if we break through, and we break through all-time highs this week,
home free, baby.
By Friday,
home free.
You can
100%. After so much rejection over and over and over.
You break down, no. You probably are going to see new relative lows. That's where I'm thinking this market is at right now. It's either all-time highs and we skyrocket higher here over the next couple of weeks, and then we start seeing our November and December setup, election setup, and all of that, or we break down and we have a situation where mid-October probably would be that seasonal low.
That's still so far away. The point is that we basically came back to the exact same point, which is that, to me, once we spent so much crucial time basically exploring this range, to me it seems like volatility either through or rejection more likely than getting stuck here for 5 days again.
Yeah.
That's kind of my main thought. On which direction, at this point, I have no clue, no bias. But it seems, and I don't know, I did say this 3 weeks ago, and it was dead wrong because we got stuck in the range again.
Yeah.
But I'm doubling down. To your point, I don't think we get stuck here again.
Well, okay, so if I'm being biased here, seasonality tells us we break down.
Right. Because didn't you say that, didn't we have like one of the worst days like historically, seasonally? We're like in that patch.
Yeah, we're in that patch over the next
all September.
Over the next 2 weeks. So if we're at the make or break point and we have traditional seasonality, and we have to we don't have to nerd out on this, but algorithms, right? We have to be mindful of them. They're also price learners as well. They're seasonality learners.
So it kicks in the bias, right?
Exactly. So all you need is one catalyst to break us down, and then every single other model that's out there that focuses on seasonality and price correlations, they're going to go with whatever the primary trend is going to be. That's where you have a breakdown here. But
here we go. Here goes another classic September.
Yeah.
If we get rejected here. All right, nice. Good stuff, KG. Thank you very much.